Welcome to the Deep Dive, your ultimate shortcut to being well-informed. We unpacked complex topics, pull out the key insights.
And today, we're diving into equity lifestyle properties, that's ELS, and their second quarter 2025 results.
Yeah, we're going to cut through the noise of the earnings call, get you the crucial numbers, the strategy.
And, what it all really means for ELS and maybe the wider sector too. Your essential update, basically.
All right, let's kick off with the headline numbers. Big picture first.
Okay.
So for the first half of 2025, normalized FFO per share growth looked pretty strong, right? 5.7% year to date.
Yeah, that's solid. And FFO, funds from operations, that's really the key cash flow metric for these REITs, tells you how the actual properties are doing.
Exactly. And their Q2 normalized FFO came in at $0.69 per share, bang on the midpoint of their guidance.
Right in line. And the core portfolio performance, that was notably strong too. NOI, net operating income.
So property profit before debt and taxes.
Exactly. That jumped 6.4% in Q2 compared to last year. And what's interesting is that was 70 basis points, so 0.7% better than they guided for.
That does say something about their operations, doesn't it?
It really does. And their core community rental income, that was also up 5.5%, both for Q2 and year to date. Consistent growth there.
Okay, impressive headlines. But what's really driving this? Management kept coming back to the manufactured housing portfolio, the MH side. That seems to be the anchor.
Oh, absolutely. That's the bedrock. It's roughly 50% of their total revenue, and occupancy is consistently over 94%.
But the real kicker seems to be the ownership model, right?
That's the secret sauce, isn't it? 97% of their MH residents own their homes but rent the land from ELS.
Which is fundamentally different from typical apartment renting.
Totally different. These folks have skin in the game. They own the structure. So they don't just pick up and leave. You get much lower turnover, longer stays, really consistent cash flow, and just less volatility overall for ELS. It's a super stable setup.
And they also talked about the sense of community. How much does that play into it beyond just the financials?
I think it's huge. It's not just numbers.
Yeah.
That community vibe, that sense of belonging, it's like a retention magnet.
Right.
It keeps people there long term, builds that value, and the demographics line up perfectly. 70% of the MH portfolio is for seniors. That's a growing market looking for exactly this kind of affordable community living.
And geographically, where are these MH powerhouses located?
Mostly Sunbelt. Florida, California, Arizona, that's about 2/3 of their MH revenue right there.
Okay.
Florida, especially Tampa, St. Pete, has seen huge demand, like almost 700 new homes sold in 5 years because people are moving in.
Wow.
California, even with its crazy housing costs, their communities are full because they offer good value compared to the alternatives.
Makes sense.
And Arizona, Phoenix, and Mesa, they sold 800 homes in 5 years and added 700 new development sites. They're tapping into that aging population trend, people wanting affordable, low-maintenance places.
And they're investing in new inventory, too, to keep things fresh.
Yeah, strategically putting in new homes improves the quality, it keeps property values up, and it works. People stay an average of 10 years in these homes.
Okay, you mentioned affordability, stability. What about interest rates? Everyone's watching those. How does it affect this MH model?
Well, here's the thing, and it's pretty remarkable. Around 90% of their MH customers pay cash for the home itself.
Cash. Really?
Yeah. So think about it. When interest rates go up or down, it barely touches this part of their business. These buyers aren't financing the home purchase in the same way.
So they're kind of insulated.
Pretty much. It's like a shield against rate fluctuations for a huge chunk of their revenue, a massive strategic advantage right now.
Okay, that MH stability is clear, but let's contrast that with the RV side of the business. It's got different dynamics, right? Balancing annual and transient.
Right, it's a different beast. The annual RV side's actually quite strong. Revenue grew 3.9% year to date. That's driven by good retention, people staying put in their park models, cottages, RV spots.
And annuals are the bulk of the RV revenue.
Yeah, over 70%. That provides a nice stable base. And they've got a smart geographic mix too.
How so?
About 70% of that annual money comes from Sunbelt spots retirees, snowbirds looking for warm communities. The other 30% is more summer focused, families doing seasonal recreation. That balance helps smooth things out.
And they're getting awards for quality too, I saw.
Yeah, 55 TripAdvisor Traveler's Choice Awards for 2025. That definitely helps.
Now, these annual RV folks, they're basically treating these spots like second homes, paying yearly.
Exactly. It's not just a weekend thing. They pay, on average, $6,600 a year, like $550 a month for a vacation property, basically. And you see multi-generational stays, families coming back year after year. That stream's grown 7% over the last 5 years. It's sticky.
But the transient side, the short-term stays, that's where things got a bit bumpy in Q2.
That's where the challenge is, yeah. The booking window is always short for transient. People decide last minute. And Q2 weather just didn't cooperate.
Ah, the weather factor.
Yeah, cool start to spring, rain at weekend camping, especially up north and in the south central U.S. So seasonal rent was down 5.6% year to date, and transient itself dropped 8.6%. Yeah. Just much more sensitive to things like the forecast.
Okay, now here's a nuance on the RV side that caught my eye. They tweaked their annual RV and marina revenue guidance down a bit. Said the Q2 miss was occupancy, higher attrition, specifically in the northeast.
Right, that was interesting. They dug into that. Historically, annual RV turnover is only about 5%.
Pretty low.
Very low.
Yeah.
But they're seeing higher turnover right now. Their explanation was this COVID peak demand cycle.
Meaning
during the pandemic, lots of people rushed into RVing and these annual sites, maybe more than usual. So now as things normalize, some of those folks are cycling out. It's like an echo effect from that demand surge.
So it's a normalization, not necessarily a sign of underlying weakness.
That's how they framed it, yeah. A return to more normal patterns after an unusual peak. It usually happens around June anyway. Plus, they mentioned 2 marinas had storm damage, which took some slips offline, adding to the turnover there.
Got it. Okay, shifting gears slightly. Beyond the segments, their overall operational execution, especially on costs, seemed really strong.
Oh, yeah. The Q2 core NOI growth, 6.4%. The core rental income up 5.5%. Solid rate growth at 5.8%.
And the membership business chipped in nicely, too.
Yep, $16 million in Q2, over $31 million year to date.
All right.
But the expense control was the standout for me.
Flat. Core operating expenses were flat year over year in Q2. How do you even do that right now?
Right. In this environment, it's impressive. And it was 190 basis points better than their own guidance. Came from savings on utilities, payroll, membership costs, even property taxes.
Can they keep that up, though? What's the trick?
Well, year-to-date expense growth was only 0.7%, and that includes their big insurance renewal in April. They're using tech, like scheduling tools, to manage staff hours, cut overtime. Smart stuff. They estimate the big buckets, utilities, payroll, repairs, that's like 2/3 of cost, will only be up about 2.4% for the year. And the rest, taxes, insurance, membership marketing, they actually think will be down 1% because of good insurance rates and savings on membership products.
Wow, actively managing it. What about development? They're adding sites. How does that play into occupancy numbers?
Good question. They've added quite a few, 1,500 MAGD sites, 2,900 RV sites over 5 years. Costs are up, sure, but so is the revenue from those new sites.
Right.
And they clarified the occupancy reporting. It looked like it was down 60 basis points, but they said total occupancy was basically flat. The percentage looks lower because they added new sites to the denominator, the total site count.
Ah, okay. So the number of empty sites didn't really increase much.
Exactly. Negligible loss, like 40 sites. And their MH lease up is steady, like 25 to 50 sites a year per development. They build them expecting to fill them over 3 or 4 years. Controlled growth.
Okay, makes sense. And all this is built on, presumably, a solid financial foundation, balance sheet.
Very solid. No secured debt maturing before 2028. Average debt maturity is almost 8 years. Debt to EBITDA is healthy at 4.5 times. Interest coverage is strong, 5.6 times.
And access to cash if they need it?
Plenty. Over $1 billion available through their line of credit and ATM programs combined. They have flexibility.
And they did some financing recently.
Yeah, closed a $240 million unsecured term loan, used it smartly, paid off some maturing secured debt, paid down their credit line, and funded a loan to a joint venture. Just prudent capital management.
And it sounds like the market still really values these MH assets for financing.
Absolutely. High quality, age qualified MH gets the best terms. Lenders see the stability. As for acquisitions, things have been quiet on that front.
Yeah, not much deal flow mentioned.
Right. Management just noted the market's fragmented, lots of potential owners out there. They expect chances to buy will pop up when the transaction market thaws out a bit. Hard to talk cap rates when nothing's really trading.
Sure. Okay, so let's look forward. What's the guidance telling us for the rest of the year and maybe peeking into 2026?
They're holding the line on full year 2025 normalized FFO guidance. Midpoint is $3.08 per share. That implies about 4.9% growth over last year.
Okay, maintaining guidance despite the RV headwinds.
Exactly. Q3 FFO is projected between 72 cents and 78 cents. Full-year core property income growth is pegged at 5% at the midpoint.
And the assumptions behind that.
Assumes strong MH rent growth, 4.9% to 5.9%, but more modest RV and marina rents growth, 0.6% to 1.6%. And they're baking in that transient weakness, projecting seasonal and transient revenue to be down 8.4% in Q3 and 6.4% for the full year.
So acknowledging the transient issue in the forecast, what about looking further out, like rate growth for 2026?
So set the 2026 memory H rates later this year, Q3, Q4. They still see consistent demand there. For RV annuals, they're thinking rate growth around 6%, probably effective next April.
But watching costs for next year too?
Definitely. Keeping an eye on utilities, payroll, repairs, things like tariffs, inflation impacting wages. They seem proactive on cost management.
And that Canadian demand point. Any major impact from visa fees or slower bookings?
The early bird program for Canadian seasonal folks was down 20%, but they expect it to pick up. As winter gets closer, people start thinking Sunbelt again.
Makes sense.
A tiny pullback in Canadian transient visitors up north, but not a big dollar amount. The $250 visa fee, probably minor impact. Most Canadians don't need a visa for short stays anyway. No real change seen in MH demand from Canadians, especially in places like Phoenix.
And resident financial health. Delinquencies low.
Still very low, 30, 40 basis points, super consistent, even through the pandemic. No red flags there.
What about home sales? Sounds like volume is down a bit from pre-COVID levels.
Yeah, volume's lower. Q2 was maybe 117, 120 sales versus a more typical 500, 600 a year pre-COVID. Average prices are a bit lower too, partly mix, partly less demand for the really high-end stuff.
And they see these sales as a loss leader.
Kind of, yeah. The goal isn't necessarily to make a killing on the home sale itself. The real prize is getting that site occupied and locking in that long-term, high-margin land lease income. So selling the home, even at a modest profit or break-even, gets them the recurring revenue stream.
Got it. All right, let's shift gears. Time for our not financial advice segment. The wild, but maybe plausible, trade idea.
Okay, let's brainstorm like we're pitching the investment committee. You see this split, right? Super stable MH, more volatile transient RV.
Yeah, clear difference.
So here's a thought.
Yeah.
What about going long ELS?
Okay.
Paired with a short position in a REIT that's much more exposed to that transient leisure travel, maybe a hotel REIT or something similar.
Interesting. So the thesis is leverage ELS's steady cash buyer MH base, which laughs at interest rates and rides demographic waves.
While betting against assets that are way more vulnerable to weekend weather, gas prices, just general discretionary spending whims.
So a relative value play, capitalizing on ELS's unique stability versus the more cyclical travel market.
Exactly. Purely illustrative, of course, not financial advice, folks.
Definitely not advice. Okay, so wrapping this up, what's the big takeaway for listeners?
Well, ELS keeps showing how resilient that core manufactured home business is. High occupancy, homeowners who stick around, smart investments, it's working.
Yeah, and while the RV side has some bumps, mainly weather and that post-COVID normalization,
management seems on top of costs, and crucially, they're sticking to their full-year FO guidance.
Right. So the Q2 deep dive shows a company navigating some choppiness, but with a strong balance sheet and a clear focus on those sticky, long-term revenue streams.
Absolutely.
So here's something for you, the listener, to think about. As demographics keep shifting and people keep looking for affordable, community-focused living, could manufactured housing and these long-term RV sites become even more valuable, maybe even a preferred choice, especially if the broader economy stays uncertain?
Good question to ponder. Thanks for joining us for this deep dive. We'll catch you next quarter with another update.